Fed Chairman Jerome Powell signaled a potential change in course in the Fed's inflation fight, leaving many to wonder why, given that we are experiencing the highest inflation in over 40 years that still has not peaked. I mean, it's not like the stock market is broken and the economy is in recession. What's that? The stock market's broken and the economy's in recession? Fed Chairman Jerome Powell has signaled that the Fed is worried about further breaking the stock market and completely collapsing the U.S. economy, and could be changing course in their inflation fight. In today's video, we're going to take a look at what he said, what's going on with stocks and the economy, and ultimately, what all that means for the housing market. Let's get into it. At the conclusion of their two-day policy meeting, the Federal Reserve raised their Fed funds rate by 75 basis points. But what was perhaps more important was Fed Chairman Powell's tone at his press conference following the announced decision on interest rates. Powell said that the Fed could slow rate hikes in the months ahead and that the Fed is aware of the negative impact of its rate hikes on the economy. Wall Street loved it, and stocks rallied on the more dovish tone. For some, this move might be a bit puzzling. After all, we're experiencing the highest rate of consumer inflation in over 40 years, which has yet to peak and could head higher still. So what's going on? Why the change in tone? Former Fed insider Danielle DiMartino Booth said it best that the Fed will keep raising rates until they break something, and break something they have. The S&P 500 was pushed into bear market territory as the Fed began their rate hiking back in March, and just recently we learned that gross domestic product, or GDP, experienced negative growth for the second consecutive quarter, meeting the criteria for a technical recession. Now, to be clear, the breaking the Fed has done has just put cracks in financial markets and the economy. And this change in tone could be a recognition that if they put further strain on the system with higher interest rates, those cracks could turn into a collapse. The stock market's health has already improved as we've seen the S&P 500 rebound from its bear market lows, and through the end of July has risen 12.6% since the recent low on June 16th. Wall Street seems to be feeling much better after hearing Powell's comments on slowing rate hikes. With respect to the economy, both the Fed and the White House have been pushing the narrative that 2 quarters of declining GDP does not mean that we're in a recession. Powell himself has said directly he does not think the U.S. is in a recession, and one of the biggest reasons for this is that the unemployment rate is still low and the economy is adding jobs at a brisk pace. Janet Yellen, the current Treasury Secretary and former Fed Chairwoman, says the economy is in a state of transition, not a recession. She also cites continued job creation as a major reason for this. The logic goes that if the overall economy were actually contracting, why would businesses still be hiring workers? And given that an economy in recession would not bode well for Democrats in the upcoming midterm elections, the Democratic administration in the White House is pushing it into overdrive to communicate to the American people that we are not in a recession. They are technically correct. The National Bureau of Economic Research is the official arbiter of what constitutes a recession. I'll be covering the latest GDP report on my other channel, PapayaCast, and I'll do a deep dive into the latest data and let you know what could be coming over the horizon for the economy. On that channel, I focus more on overall economic analysis, not just the housing market as I do here. In addition to being a licensed real estate agent, I am also a professional private sector economist with over 6 years experience in industry outside of my academic experience. So you'll get the same quality of analysis on the overall economy there as you get on the housing market here. So if you're not subscribed on that channel, Make sure you do so you know when that video comes out. I'll leave a link to the other channel in the description down below. I haven't posted over there in a while as I've been focused on housing market analysis on this channel, but entering a technical recession is big news, and I'll give it its proper treatment there. Now, since this video is on this channel and here we're focused on forward-looking real estate analysis, here's what all this could mean for the housing market. Fed Chairman Powell's more dovish tone at his press conference could be signaling that they might be slowing down and hiking interest rates. This would mean we could be seeing a cool down in mortgage rates as well. For my regular viewers, you are familiar with the housing market scenarios that I do about once a month, and this move by the Federal Reserve is in line with my baseline scenario for the housing market, where the Fed raises their Fed funds rate by 75 basis points at each of their remaining meetings this year to combat inflation. Here's one of the big questions though. Will this be enough to bring down the rate of inflation that has yet to see a peak? So far, we are at 2.25% for the Fed funds rate, which is still significantly lower than the current 9.1% rate of consumer inflation. It's worth noting, as I have done in previous videos, that the last time the Fed had to seriously fight inflation back in the 1980s, they had to raise the Fed funds rate 20% higher than the rate of consumer inflation in order to bring it down. So far, they are way behind the curve if they genuinely intend to bring down the rate of inflation. Time will tell, but in the meantime, here's what this means for mortgage rates if the Fed raises their Fed funds rate by 75 basis points at each of the remaining 3 meetings in 2022. Based on a historical analysis between the Fed funds rate and the 30-year fixed rate mortgage, as well as recent movements in mortgage rates the last few months, I estimate that the 30-year fixed rate mortgage could reach 6.2% by the end of 2022. Now, obviously, this is not going to be good for housing prices going forward as rising mortgage rates deteriorate home affordability. But with Fed Chairman Powell's change of tone, we could be facing a scenario where they stop raising rates altogether or just do a few more 25 or 50 basis point increases if they're concerned about pushing the economy into deep recession. Let's say the Fed raises rates one more time by 75 basis points at their next meeting in September and then stops there. In that scenario, that would put the Fed funds rate at 3% by the end of the year, which would correlate to about a 5.8% mortgage rate. This would be good news for home prices and would likely avoid a full-blown crash in the housing market that so many think is on the way or has already started. In my most recent video on the latest housing data from Redfin, a national real estate brokerage, I highlighted how we could be at a major turning point for the housing market as the U.S. median price registered its first month-over-month decline since the pandemic started. I'll soon be releasing my updated scenarios for the housing market showing under which conditions we could see a full-blown crash of up to 30% for home prices and which path seems the most likely at this point. If you want to stay up to date on all the latest for the housing market, make sure you're subscribed and hit that notification bell down below so you know right away when my next video come out. The upcoming video on my updated housing market scenarios will go in depth on all that has happened in the last month. If you found this video useful, please give it a thumbs up to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.